if you're good at the square and the X, you can explain the basics of cash value versus term. What I'm about to do with you is what I did when I was brand new. We call it the square and the X. What I'm about to do is what I saw at Margate when my team was me. And I'm like, okay, the crusade, like guys, Tuesday night, we're going to get into the crusade too. We're going to teach the product. But we're going to get people emotionally involved. Dang, man, we got to talk to people, okay? So when you're dealing with the life insurance, I'm actually going to do it this way, Jerry. Hopefully, okay. So, oh, by the way, a couple comments about the financial house part. Some of y'all made the houses like Honey, I Shrunk the Kids. You made your house so small. You write them large enough, especially for old people like me and Henry. But you need to draw the house on a large enough so so people can see it. Now make sure you do it where you can still write down the commitments and all that. But y'all with me? So when you write the numbers, you're able to do that. Okay. Like quite honestly, the one I wrote, I probably made it a little small. Should have made it bigger. Okay. And also when you do it in a house, you're going to use a pen. You're not going to use a marker like we are today, right? Okay. So what I'm going to do now is I'm going to say, Bill, Sue, there's two basic kinds of life insurance. Have you ever heard the difference between maybe term insurance or whole life maybe? And they say yes, no. I go, well, let me kind of show you how they work, okay? The first one is called cash value life insurance. And a lot of people, this is the traditional called whole life insurance. Now, I'm not a great artist, but you'll kind of get this. And I said, now, here is a 30-year-old spending $935 a year for life insurance, okay? Which is about $76 a month, okay? Thereabouts. Part of the money bought the life insurance, okay? Meaning if he dies, Susie gets $100,000, okay? Now, part of the money, the agent said, we're going to build a savings program inside the policy called cash value. So what's going to happen is he's going to say, look, Alan, if you die, Dina gets how much? How much? Make them say it. And now, but there's a chance you might live, and when you retire at 65, you're going to have about how much? 45. Now, here's what they don't tell you. The Federal Trade Commission says the average rate of return over the lifetime of the policy is somewhere between 1% and 4%. There's places longer than we've been alive that have done way better than that. Would you agree? Mutual funds, for example. Now, 1% to 4%. Now, have you ever heard of people borrowing from their life insurance policy, Mr. and Mrs. Smith? I think, yeah. Now, they can borrow the money generally at 6 to 8% interest. Well, whose money are they borrowing? Does that make any sense to you? Now, they do say, listen, Alan, as you're putting money in this policy, remember, you right now, $935, part of it buys a death benefit, part of it buys a cash value. So let's say at age 45, you've accumulated about $10,000 in cash inside the policy. Now, if you need a loan, first of all, and you pull the money out, let's say you borrow $5,000, you got to borrow your own money, remember? Yep. By the way, just so you know, if you die, they subtract that from the death benefit. Dina now gets $95. Even though it's your own money, they subtract from the death benefit. Isn't that crazy? And they go, yeah. Here's the thing that blew me away. Get people emotionally involved. It blew me away. Let's say you're 55 and you've got $20,000 in cash value in the policy and you were to die. Did you know on a typical whole life policy, you'll lose your cash? Did you know that? And they go, no. I go, by the way, let me kind of explain this to you. Let's say at 55 you had $20,000 in cash, right? The longer you keep the policy, all you're doing is reducing the insurance company's liability. Because if you die, they're going to pay $120 of it was your own money. So we believe if you need life insurance, you should be doing this with them. If you need life insurance, have life insurance over here. Just like you have car insurance, don't you? Health insurance, homeowners insurance. Is there any savings attached to your homeowners, or is it just insurance? Just insurance. Have insurance here and have investments here. Separate the two. Make sense? So let's pretend we did that. Let me show you what we do. Let's do apples for apples. Let's take the same $935 a year, and we do what's called term insurance. Ours is guaranteed renewable. We can give that same 30-year-old $200,000 in life insurance for about $310 a year. It's like $25 a month. Now, we saved them how much? $625. Now, Bill, if you ask Susie, if you die, do you want 100 or 200? Susie, which one are you going to pick? Pick the big one. It's okay. He would pick the big one too. Don't worry. It's all right. Now, if you take that money and you separate it and you put that in just a decent mutual fund, by the way, you guys, we used about a 10% return, like equity and income, 50-year track record. At 65, you would have accumulated about $280,000 in cash. Now, let's compare the two programs for a minute. This family versus this family. Let's say we put the client from here to here. Do we agree that we could probably get a better rate of return outside of a policy just in a mutual fund?
Yes.
So you solve this problem of a poor return. Agreed?
Yeah.
Now, let's say they're taking the money and they're saving and investing, and let's say they've accumulated $10,000 in cash. The investment does terrible, like the whole life policy. And the client needs $5,000. You know what they do? They call up the mutual fund company, or today you just go online, and you say, put $5,000 in my checking account. And they move it into your account within 2 days. Do you have to borrow your own money? No. See, we solved that problem too, don't we? We separated it. Let's say he died. In this example, if he died, here, let's use this one. If he died, how much will she get? When he's 30 and she did this, which said when he's 30 and he dies, how much she get? When he's 55 and he dies, how much does she get? Let's look at our plan. If he dies here, right? How much does she get?
200.
But the 200. But this is outside. It could be under your mattress. It's still better, wouldn't it? So let's compare the two plans, A and B. $935 a year. If you live, you got $45,000, to retire in luxury. If you die, you got $100,000. Let me be this is powerful, by the way. Let me be very clear. Mr. Smith, the only time you'll ever see your cash, because it's on your life, is while you're alive. You will never get the cash because they either pay the death benefit or the cash value. See, if you die, she gets 100, right? Right? Yeah. If you cancel the policy, you can get the money out, but don't die now because now you got 45 grand, right? So if you compare the two, here's B, $935. If you live, you got how much? If you die, the death benefit's how much? See, I point at it. But if you die on the way, you get the life insurance plus whatever cash was in the account, right? I go, can I really have fun and mess with you? You go, yeah. When you get to 65, how much you got in cash with us? Cancel our policy. They go, cancel it. Because people, well, in 20 years, how much is it going to cost? They're still in the old way. Cancel it. Why? And I get them involved. If you canceled our policy, how much is in your mutual fund? Is your wife the beneficiary?
Yes.
So does she get how much?
20.
Your old plan. If you died early, how much does she get?
100,000.
If you keep it till you're 100, how much does she get? 100,000, right?
Yes.
So will this plan ever be better than this plan?
No.
I go, you'll never hear somebody with an insurance license say, my job is to get you out of your policy as soon as possible. I said, the problem is, and I'm just going to kind of hold it out. I fold it in half, and I say, see, the insurance industry says, how much do you know about life insurance? And they go, not much. I go, see, it's there somewhere, okay. Forget it, I'm trying.
It's at the bottom.
Oh, it's at the bottom, okay. You don't know anything about life insurance. They sell you this one, okay? It don't matter, y'all get the point. They sell this one, but they own term on their own life. You know why? Because they make 7 to 10 times more money selling cash value versus term. But if you put a gun to their head and said, let me see your policy, unless they're a total moron, they own term insurance on their own life anyway. Guys, if you ever see an agent, oh, I've got that policy. A, they're lying. I'm serious, they're lying. Or B, they don't understand the product. Because if I sat with them and I know their product's probably better than they do, when I sit down with them and go, let me explain what you bought. Guys, I've met people in Primerica that used to sell Universal Life. And they'd go, this guy Steve, who was in Kevin's bait shop years ago, he goes, I didn't even know what the hell I was selling because I owned it on my own life. So then when I say, by the way, too, just a little footnote, and then we're going to practice, is I'll say, can you pretend for a minute, if you had this plan right here, you got buy term and invested difference, like your car insurance, right? You got this plan, and the best salesperson on the planet comes in your house and goes, Arlene, Angel, I've got a better plan. I propose, Angel, I think you're being kind of greedy. You want $200,000. I think you should pay the same amount with me, and I'm going to give you half the amount of insurance. I think 100 is adequate. And having all this money at retirement, $280,000. I really think you ought to have way less. I think you should cancel that and have 45 with me. Oh, and pay the same premium. Now, is there any way possible someone could get you to cancel 200,000 and 280 at retirement to buy 100 or 45 at retirement with the same money you're currently spending? And they go, no. I go, it's heck no, right? So I might use those kind of things. Y'all get this?
Yeah.
Pretty powerful, right?
Yeah.
Okay, so what I want you guys to do is I want you guys to role play this and do the bit. Now, don't get into all the little thingies that I did with you on the side here. Just practice it once, and then we're going to